Here's an investment that I think could return 4 times your money in the next 4 years. I'm long the stock myself, but this is not investment advice. It's a job application. If you're a long-term orientated capital allocator that values fundamental analysis and might be interested in an analyst joining your team, then please get in touch. I'd be delighted to hear from you and to discuss the opportunity. Over the next 15 minutes or so, I'll highlight what the company does, address some key concerns, and walk through my valuation. I'm Dhiren Joshi. I'm an equity analyst here in London, and I love finding great investments. Dream Finders Homes builds houses in the US and trades on the New York Stock Exchange under the ticker DFH. It focuses on entry-level and first-time move-up houses, predominantly in southern US states. It was founded in 2008 and only IPO'd last year in 2021, which makes it a stock that most investors have not heard of. What's interesting is that as a result of its unique business model, which I'll go into, not only is it one of the fastest growing home builders in the US, but it also takes far less risk than the average home builder and generates returns that are amongst the highest in the industry. Its current market share of less than 1% means it's got a long runway to continue growing into its fragmented market. And insiders are clearly confident about the company's future, with management owning 75% of the company. Even if the company's growth slows from 50% to 15%, the stock could be worth 4 times as much in the next 4 years. But first, I know what you're thinking. Who wants to buy home builder stocks going into a recession? And clearly the market agrees with you. Home builder stocks are down 30 to 40% so far this year, versus only about 20% for the market overall. And one of the key concerns is around how quickly mortgage rates have risen to their current 6% level. To quantify this move, 30-year mortgage rates have nearly doubled so far this year, rising from 3.11% to 5.66%. And investors are concerned that this sharp rise in mortgage rates means that home builders that have spent money to buy land and build houses won't be able to sell as many of them, and the prices they'll be able to sell at will be lower, causing revenues, margins, and profits to collapse. And if these home builders had borrowed a lot of money to do this, they might go bankrupt, which is common for home builders in a downturn. One way to estimate what impact this sharp rise in mortgage rates might have on home builders and unit sales is to look back at similar times in the past. So for example, this 34% increase in mortgage rates in 2013. So looking at this graph on the right hand side first, what we see is when US 30-year mortgage rates rose 34% in 2013 from about 3.5% to about 4.5%, new home sales actually rose 15% in the subsequent year. And if you look at these two graphs, where we're looking at the absolute level of mortgage rates and the percentage change in the mortgage rate, what we see is there doesn't seem to be any correlation whatsoever in either of these to how many new homes get sold. So from this data, which I collected from the US Census Bureau, no clear relationship can be garnered between mortgage rates and new home sales, which is quite surprising in itself. In fact, the number of new US homes sold in any 12-month period have ranged between 400,000 and 800,000 units 80% of the time, with the latest data point showing 685,000 new homes sold in the 12 months to August 2022. And the driving factor behind this range-bound demand for new homes is likely the relatively steady growth in US population of about 2 million people per year. So from the data we have just seen, we can't draw the conclusion that the steep rise in mortgage rates will cause new home sales to collapse. Unit sales could fall, but the argument that higher mortgage rates are going to cause this is not supported by the historical data. And so what conclusions can we draw about home prices? Maybe the bears are right and the steep rises in mortgage rates create forced selling, and so prices will fall. Well, again, there doesn't seem to be any causal relationship between mortgage rates or changes in mortgage rates to home prices. If we look again at the steep 34% rise in mortgage rates in 2013, not only did we see a few slides ago that subsequent unit sales increased 15%, but we also see here that prices rose 7%. Again, the data is bringing out an insight that's counter to what's commonly argued. And one thing that's interesting, if you look at both graphs here, is that most of the dots are above the x-axis. And what that means is, in the past 50 years, house prices in the US have gone up in most years, irrelevant of what mortgage rates were. And the reason for the growth in house prices has been because household incomes have grown. There's a strong causal relationship between the two, as shown from this R squared of over 0.97%. And unlike new home sales, US home prices are not cyclical. US house price growth over the long term has very closely matched a 5.5% compounded growth line. And where house price growth didn't match the 5.5% rate, it's largely because of inflation. What we see here, importantly, is that new house price growth almost always has been above the rate of inflation. The point here is that if the current high levels of inflation persist, US house prices might well grow faster than the 5.5% CAGR rate over the next 5 years. So if we're thinking about what might happen to house prices over the next 5 to 10 years, our base case assumption should be that prices grow at 5.5% CAGR, and if the inflationary backdrop persists, house prices will likely grow even faster. But in addition to rising mortgage rates, investors are also concerned about the potential impact of a recession. These recession fears have been exacerbated recently with the inversion of the 3-month 10-year points on the US Treasury curve, which we saw invert on the 18th of October. While US house prices fall in most recessions, a notable exception was after the tech bubble popped in 2001-2. In fact, in the past 60 years, there have only been 4 years in which median new house prices fell: 1991, 2008, 2009, and 2019. In each case, the drop over a 1-year period was in the mid to low single digits. Prices in most cases had recovered within 5 years, and in every case, the price appreciation over the subsequent 10-year period exceeded inflation. And again, to reiterate this point that house prices tend to rise at or above inflation, the median price at which new home sales are transacting in 2022 is up 9%. To recap, steep rises in mortgage rates don't necessarily mean new house prices or unit sales will fall. House price growth tends to exceed inflation. Median US prices did not fall after the tech bubble burst, and in recession years, prices fell between 2 to 7%, then recovered within 5 years. Looking specifically at Dream Finders Homes, as of the 30th of June 2022, on a net debt to EBITDA basis, the business is far more leveraged than its peers. This is a key concern for investors. Comparing the share price performance over the last year to the levels of debt, it appears the market is performing a simplistic valuation exercise and concluding that home builders with more debt deserve a lower valuation. But of course, it's important to understand what the company is doing with the debt to evaluate how risky the company is. And to do this, you have to look at the company's business model and see if it's doing something different to its peers. Now, this is a really powerful graph because it highlights that DFH and NVR are fundamentally operating a different business model to other home builders. Their model enables DFH to convert the capital they invest into land into finished home sales within 6 months, and it takes NVR even less time at 3 months. The key difference is they use option contracts to control land and only take ownership of it when they are ready to start building on it. They don't buy up the land in advance hoping land prices rise. Because there is essentially zero time between buying the land and starting to build, not only does it protect DFH from fluctuations in land prices, but it also protects them from increasing build costs, which we have seen recently with material and labor costs rising. This greater certainty around how much it will cost to build a house when you buy the land translates into more stable margins for companies like DFH and NVR, which we'll see in a couple of slides. And because they can reduce the amount of time between buying the land and selling the house, this boosts returns on equity. These faster inventory turns also mean that when land prices do fall, DFH and NVR are in a far safer position because they don't have large land banks which need to be written down. To put this into perspective, Dreamfinders and NVR are the only two publicly listed builders that operate an option-only model and shun speculative land purchases. And because of this discipline, DFH and NVR earn higher returns and are less risky than the average builder. The lower risk of this model shines through when we look at the net income margins of NVR versus all the other home builders through the global financial crisis. NVR remained profitable throughout one of the biggest housing crashes in history, while virtually all other US home builders were decimated. Although we don't have data for DFH during that time, we do know that it has been profitable in every year since it was founded in 2008. In fact, looking back at NVR's history, DFH's recent operating results look analogous to NVR at the end of 2000 in terms of gross margins, one difference being that DFH is growing a lot faster than NVR did. In both cases, we see gross profit margins rising steadily from about 13% to 19%, which highlights the economies of scale that home builders benefit from. If they can build more homes, then their unit costs decline. And in order to scale quickly, DFH has been supplementing its organic growth with acquisitions. What's interesting is that these acquisitions have been highly accretive, with management stating that all 4 of its recent acquisitions are on track to pay back in less than 3 years. For one of the acquisitions, the purchase of H&H Homes, I've been able to go back into the historic filings and break out the true payback period. And as you can see from my calculations here, focusing on the bottom right corner, in the 2 years since the acquisition, H&H Homes has generated net income after contingent consideration payments of $23.8 million, putting it on track to repay the full acquisition cost of $29.5 million within 2.5 years. To get a feel for the validity of this strategy, it's important to appreciate that the US home building industry is fragmented, but it is consolidating. I went through the historic filings of all the largest home builders in the US, and what is summarized in this table is that one, US home building market is fragmented, with the top 10 players having only a 1/3 share, but it is also a market that is consolidating. The market share of the top 10 players rose from 25% in 2016 to 34% in 2021. And within that industry backdrop, DFH has managed to grow its unit closings from about 1,000 to 5,000 in 5 years, enabling it to triple its market share from 0.2% to 0.6%. Taking all that into account, despite being one of the fastest growing home builders in the US, taking less risk than its peers, and generating market-leading returns, it's trading cheaper than its peers. In valuing this business, I see the revenues growing to $5 billion by 2026, which implies they sell just under 9,000 homes at just under $600,000 each. These assumptions might prove to be incredibly conservative. They assume that DFH's growth slows from 50% CAGR over the past 4 years to 15% CAGR for the next 4 years. And it also assumes prices only grow at the long-term 5.5% CAGR rate, getting no boost from inflation. Then if we assume gross margins expand from 16% currently to 19% through economies of scale, net income margins rise to 9%, and the multiple rises to 8.5 times, this gives a market cap of $3.8 billion, which is roughly 4 times the current market cap. And we get this broad value to price gap even while using relatively conservative assumptions around growth and margins and multiples. The rate of return could be even higher than this. In closing, if you're a long-term orientated capital allocator and you're looking for an analyst to join your team and you like my work, please get in touch. I'd be delighted to hear from you and to discuss the opportunity. And if you're a contact or a friend and you just want to help, please share this video. It really helps to make people aware of the work that I'm doing. Thank you, and I look forward to hearing from you.